The war against Iran could not have gone better for the United States and Israel in the first week. But winning the first week of a war is not the same as winning the war. What does game theory tell us about Iran's strategy? Will Iran fold before Trump tacos? And what should you be doing with your money right now? Before I continue, I want to tell you about my book, Merry-Go-Round Broke Down, co-written with Marguerite Chenard, that will be published in the United States on March 31st. Merry-Go-Round Broke Down is a novel about globalization. Set in 9 countries and spanning over 20 years, it is an exploration of the butterfly effect of globalization. We chose to write a novel rather than another policy book to make this important issue accessible to a wider audience. Globalization has brought both good and bad, but it will be a mistake to throw the baby out with the bathwater. After 4 years of sharing my insights about the world with you, I now invite you to support my mission in bringing this important debate about globalization to the general public. The book is available for pre-order on US Amazon, Barnes & Nobles, and other major US booksellers. Just follow the link below. I truly appreciate it. Some wars matter more than others. There is a growing consensus that the war in Iran may prove to be the most consequential conflict in the Middle East since the Iraq War. Consequential, of course, can mean either good or bad. The Iraq War ultimately proved disastrous for both Iraq and the United States. For Iraq, the war imposed enormous human cost, unleashed sectarian violence, and set the country's development back by at least 2 decades. For the United States, it imposed staggering financial cost, damaged American credibility, and became a strategic distraction from the rise of China. But the fallout from the Iraq War extended far beyond Iraq. Iran's expanded regional influence intensified sectarian polarization across the Middle East, from Lebanon to Yemen. ISIS emerged from the chaos unleashed by the war and briefly controlled large parts of Iraq and Syria. Its rise also contributed to the wave of displacement that eventually sent millions of refugees towards Europe. Every war plants the seeds of the next conflict, often in ways no one anticipates. By strengthening Iran, the Iraq War set Tehran on a collision course with Sunni Arab states, Israel, and ultimately the United States. Hindsight is always perfect, but this much we can say with confidence. Hindsight is always perfect, but this much we can say with confidence. George W. Bush's decision to invade Iraq in 2003 helped set the stage for the confrontation with Iran we're witnessing today. Whether the war in Iran will have consequences as far-reaching as the Iraq War depends on how it ends. So what is the end game? Financial markets' reaction to the war so far says a great deal about how Wall Street is thinking about the endgame and the paths that could lead there. As of Thursday, oil's up, bond yields are up, and so is the US dollar. US equities are roughly flat, but equities in the rest of the world are down about 5%. Part of this price action reflects the unwinding of crowded trades that had built up before the war. But it also suggests 2 broader conclusions. First, investors see the war primarily as an inflation shock rather than a growth shock. Secondly, they believe the United States is better positioned to cope with that inflation shock than the rest of the world. Both assumptions, however, hold only if the conflict remains short. The market is clearly not pricing a prolonged war. Most investors I speak to believe that among the ranges of possible outcomes, the most likely scenario lies at the opposite end of the spectrum. Either we see another taco moment as Trump loses patience and seeks a quick exit, or that Iran capitulates as Tehran runs out of resources and the capacity to resist. Will this consensus prove correct? Will Iran soon run out of the resources needed to stay in the war? Iran is estimated to have begun the conflict with roughly 2,500 ballistic missiles. The sharp decline in its missile launch rate over the past week has led many commentators to conclude that Iran is running out of missiles. And not just missiles. Trump declared yesterday that Iran is running out of missile launchers too. Based on this assessment, some officials say that Iran may be only able to sustain the current pace of attack for a few more days. That may prove to be the case, but there's another possible explanation for the decline in launch rates. It may reflect strategic conservation as Iran prepares for a prolonged war of attrition. In the 12-day war last year, Iran held back some of its most advanced missiles until the later stages of the conflict. Is it possible that Tehran is following the same playbook again now? Like everyone else, Iran knows that Trump has a tendency to back down when pressure rises. Tehran therefore has a strong incentive to drag out the conflict for as long as possible. In fact, that may be the only way it stands a chance against the combined military might of the United States and Israel. However, to do so, Iran must force the United States and Israel to fight on terms that blunt the advantage of their superior military technology. Iran's decision to close the Strait of Hormuz should be viewed in this light. Like the Houthis at Bab el-Mandeb, Iran sits astride a critical maritime chokepoint, the Strait of Hormuz. Bab el-Mandeb is only 32 kilometers wide, and the Strait of Hormuz only 33 kilometers wide at their narrowest points. The usable shipping lanes are far narrower. The Houthis have demonstrated that under such conditions, even relatively unsophisticated weapons, anti-ship missiles, drones, sea mines, and small attack boats can severely disrupt shipping between Asia and Europe. Iran could employ similar tactics to threaten traffic in and out of the Persian Gulf. This is why it's not clear to me that the destruction of 20 Iranian naval vessels over the past week will significantly degrade Iran's ability to disrupt traffic through the Strait of Hormuz. Roughly 20% of global oil supply normally transits Hormuz, making it the most important energy choke point in the world. Tanker traffic through the strait has reportedly fallen by about 90% compared with normal levels in the last few days. 20% of global oil supply is roughly 20 million barrels per day. The relationship between oil prices and supply disruptions is highly nonlinear. Because both supply and demand are extremely inelastic in the short run, even relatively small disruptions can generate large price movements. The roughly 30% rise in front-month oil futures since the start of the year suggests that the market is pricing a temporary disruption of about 2 million barrels per day. Given that Iran's own oil exports are already close to 1.5 million barrels per day, this implies that the market is not pricing anything close to a prolonged closure of the Strait of Hormuz. Such a closure will remove a much larger volume of oil from the global market and would likely have devastating consequences for both the global economy and the US economy. This is especially true given the continuous sanctions on Russian oil exports. Given the above, the only plausible explanation for the resilience of the US stock market is that investors do not believe that Iran will be able to block the Strait of Hormuz for more than a few days, or that the market thinks Trump will tackle before oil prices go much higher. I think the market may be underestimating Iran's ability to stop oil from leaving the Persian Gulf. But it may also be overestimating the likelihood of a Trump tackle. This is because the Supreme Court's ruling against Trump's tariffs has, for all practical purposes, rendered him a lame duck president. I argue in several previous videos that Trump's idea of a $2,000 tariff rebate was the only chance that he had to put the Republican Party in a competitive position ahead of the midterm elections. The Supreme Court's decision has extinguished any realistic chance that Congress might rally behind that idea. With increasingly limited room to maneuver on his domestic agenda, foreign policy may now be the only arena where Trump can make his mark. Lame duck presidents often shift their focus from politics to legacy. Richard Nixon, Bill Clinton, and Barack Obama are just some examples. Arguably, for good or for bad, Trump's most important foreign policy legacy will be Iran. He walked away from the Iran nuclear deal in his first term, reimposed massive sanctions on Tehran, and ultimately ordered strikes on Iran's nuclear facilities last year. In many ways, the trajectory of Trump's presidency has been inseparable from the confrontation with Tehran. Trump cannot back down over Iran now without looking very weak. This is especially the case given the deepening of ties between Iran and China. In a previous video, I discussed the completion of the Iran-China Railroad, which will soon render U.S. sanctions on Iran's oil exports far less effective. Reports that Iran has recently deployed some of China's most advanced radar systems, and that the two countries are close to concluding a deal for anti-ship supersonic missiles, lend additional support to the view that the window for the United States to impose its will on Iran may be closing fast. Given the above, I think Trump will not and cannot toggle on Iran. Trump said 2 days ago that he has never had more compliments than for his decision to strike Iran. He added that people felt it was something that had to be done. I think he meant what he said, for once. It sounded pretty personal to my ears. In my humble opinion, investors buying the dip in stocks in expectation of another Trump tackle may be in for a disappointment. The market is treating the Iran war as an inflation shock rather than a growth shock. This reflects the belief that the war and a disruption to oil supply will be short-lived. Relative to market expectations, I see no easy way for the United States to loosen Iran's grip on the Strait of Hormuz. Nor do I see Trump backing down anytime soon. If I'm right, the war will get uglier before it gets better. The investment implication should be clear. It is too early to buy stocks on dip. Thank you for listening.